Okay, let's unpack this. We've got these sources here, and wow, they tell a truly wild story. It's about this crypto trader, James Wayne.
Right, the one who had that absolutely meteoric rise, and then, well, the fall was just as dramatic.
Exactly. It felt like, a modern gold rush fairy tale, turning a few $100s into tens of millions in just over a year,
Incredible speed.
only for it all to just vanish. Days. One giant bet gone wrong. A $1.25 billion leveraged Bitcoin position.
Just a total nightmare ending to what so many people saw is like a living legend.
Mm-hmm. And what's really fascinating digging into these sources is that his story isn't just some isolated crazy event, right?
Not at all. It really ties into these much bigger themes we keep seeing, like what really drives market movements. It's often not the obvious headlines.
Yeah, and grappling with our own psychology, how our own minds mess with our decisions.
Absolutely. And then there's the crucial bit, risk management, the kind that separates the long-term survivors from those sort of boom and bust cycles.
Okay, so our mission for this deep dive then, using these sources you've shared, is to really dig in. We want to pull out the key lessons, maybe some painful ones from James Wayne's whole experience.
And understand who was actually behind that recent U.S. stock market rally. Because everyone was talking recession, but the market went up.
Right, who was buying? And explore why our own brains can be, frankly, our biggest enemies when investing.
And finally, pull out some practical top-tier insights, stuff from professional risk control philosophies.
Think of this as your personal guide, maybe, to navigating these pretty complex markets and trying not to become the next E, that great term for the retail investor who kind of gets chopped down.
Yeah, let's try and avoid that.
Yeah.
So James Wayne, the story really is the perfect dramatic start. The sources lay it out. Started late 2022, just a few $100.
Pennies, really.
And through super aggressive, high leverage trading, mostly meme coins, really volatile stuff, he somehow built up tens of millions in just over a year.
And the legend got cemented with that Pepe coin bet, didn't it? The source mentioned he got into a coin with like a $600,000 market cap.
Yeah, tiny. And wrote it up to, what was it, $25 million.
Unbelievable. And you can imagine sharing screenshots of those huge profits on his X account.
Oh, yeah.
He instantly became this idol for retail investors dreaming of striking it rich like overnight.
But, well, here's the turn. As the wealth exploded, his risk appetite just went through the roof.
Mm-hmm.
And as Bitcoin was getting close to its all-time high, he made this absolutely stunning decision. The sources detail it. A $1.25 billion long position with 40x leverage.
Okay, hold on. 40 times leverage. Just to be clear for everyone, that means for every dollar of his own money, he was borrowing and controlling $40 worth of Bitcoin.
Exactly. Pure borrowed power.
And with that massive position, $1.25 billion, entered around $109,000 per Bitcoin. His liquidation price was set just under 4% away, around $105K.
Which is just terrifyingly close. The sources really hammer this point home.
Yeah.
Bitcoin is volatile, right? Its daily standard deviation is around 3.58%, according to the source.
So a normal daily swing could wipe you out.
Pretty much. At 40x leverage, a move against you of even one standard deviation puts you right on the edge. This wasn't really trading anymore,
No.
It was pure high-stakes gambling, risking absolutely everything.
And markets, well, they do what they want, don't they? The catalyst wasn't even crypto-related here.
Exactly. The sources point to this seemingly unrelated macro event. News breaks. Trump's threatening tariffs on the EU. And that just sent ripples of volatility everywhere. Global markets react. Bitcoin follows suit, starts dropping fast.
Could you imagine watching that screen? Bitcoin sliding? The source describes it as just heart-stopping. Millions just evaporating. Per minute.
Yeah, like $13.4 million gone in minutes. The price just kept falling. Bang, hit his liquidation line.
Yeah.
$105,000.
And then
Automatic liquidation. The system forces the sale. 949 Bitcoin, worth about $99.3 million then, just sold off. Zeroed out the bet.
and his account, the one that showed $83 million in profit just recently.
Reduced to $16.28.
Oh, $16.
The whole rise, all that leverage, all the daring bets,
Were wound.
gone in days.
And his reaction afterwards, the sources mentioned he blamed market manipulation.
Right, the usual suspect.
Rumors flew about him having other positions to offset it. He said, no regrets, vow to come back. But the perspective shared in the sources here is so key. Recovering after you lose your principal like that, it's way, way harder than the climb up.
Exponentially harder. Survival is everything.
Exactly. Getting rich is one thing, but keeping it, that's the real challenge. Money can actually disappear completely. Opportunities, though, they keep coming if you can just stay in the game.
Which raises this really important question, doesn't it? Amidst these crazy individual stories
Yeah.
and all the talk of recession and crisis, why did the U.S. stock market, the S&P 500, rally so strongly? It was up nearly 15% since late April. Who was actually doing the buying?
Yeah, you'd think, okay, it must be the big institutions seeing something fundamental changing, or maybe reacting to news like Trump pausing tariffs, like you said.
That's the traditional view, but the sources suggest, well, a different picture, leaning more on those behavioral finance insights.
So who was it then?
Well, what's fascinating, according to these sources, is that the primary drivers weren't just the usual giant institutions. First, and this might surprise some people, retail investors.
You and me.
You and me.
Yeah.
The sources say retail was a massive force, aggressively buying the dip, like full-on buy the frickin' dips mode.
Is there data on that?
Oh, yeah, striking data. On one single bad day in April, retail investors apparently bought $4.7 billion worth of stocks. That's the highest single-day flow in decades.
Wow. $4.7 billion in one day from retail.
Yeah. And FOMO, fear of missing out, definitely kicked in hard, fueling the rebound buying as prices started recovering.
Okay, so retail is huge. Who else?
Second driver, passive investing, your index funds, your ETFs. They weren't really making active calls based on the news.
They just buy because money flows in.
Exactly. Continuous fund inflows meant they had to buy the underlying stocks, regardless of sentiment. There were constant net buyers through that April volatility, soaking up selling pressure from others, like hedge funds.
Interesting. And that passive buying is even cited as a reason why volatility was maybe lower before this recent period.
Yeah, it acts as a kind of steadying force, consistently adding demand.
Okay, so retail and passive were big buyers. But wait, what about the smart money, the hedge funds? You mentioned they were selling to passive funds but also participated. How does that work?
Yes, their behavior is definitely more complex. The sources break it down. They did jump in. They bought heavily into those early April dips trying to catch the bounce.
But they didn't stick around.
Quick to take profits, mostly. They're flexible, right? Good at catching dips and bounces, but often with shorter time frames for those specific trades. But here's the really crucial part the sources highlight.
Okay.
Despite playing the rally in some ways, hedge funds are actually increasing their short positions on S&P 500 stocks right now.
Increasing shorts while the market rallied.
Yep. Short interest is now around 2.3% of the float that's the shares available for trading. And this is the first time it's been above the historical average since way back in 2021.
That feels counterintuitive. Why would the smart money be getting more bearish, or at least more hedged, during a rally?
Well, the sources point to several big reasons. First, just a lot of uncertainty around potential Trump policies like those tariffs we mentioned.
Yeah.
Wall Street hates policy uncertainty, maybe even more than known risks like a recession.
Okay, policy uncertainty. What else?
Second, ongoing fuzziness about the Fed. Where's inflation really going? When will they actually cut rates? It's still pretty unclear. Third, the macro data itself is kind of unstable. You get conflicting jobs reports, inflation numbers bounce around.
Yeah.
It just adds to worries about volatility.
Makes sense.
And finally, market valuations are high, especially in those big tech names that led the rally. There's this fear that after such a strong run-up, a downturn could be coming.
So all that combined means most big institutions haven't really piled back in with huge overall long positions. They're staying cautious, defensive.
They're strategically hedged, yeah. They're not betting the farm on the rally continuing unchecked.
Okay, so it seems like these external market forces, who's buying, who's selling, it's only part of the picture. James Wayne's story, and even other stories mentioned, like your friend's experience.
Yeah, that painful one.
It really points to something deeper, more internal, doesn't it? Something that affects all of us investors.
Absolutely. And this is where behavioral finance comes in and offers such critical insights. It's this field that blends psychology and finance, and it basically throws out that old idea of investors being perfectly rational robots.
Yeah.
It shows pretty clearly how our cognitive biases, our emotions, these mental shortcuts we take, they massively influence our decisions and often lead us straight into irrational choices that cost us real money.
Let's break down some of these traps then. Using James Wayne and maybe that friend's story, the first one that just jumps out, especially after huge success, is overconfidence.
Oh, definitely. Look at James Wayne. Starting with almost nothing, making tens of millions so incredibly fast. It's almost impossible for that not to inflate your belief in your own skills, your own predictive power.
You feel invincible.
Totally invincible, especially when it happens quickly. And that overconfidence is almost certainly what led him to take those massively oversized, super high leverage bets, like the 40x Bitcoin long with almost no margin for error.
He just ignored the risk.
Ignored the fundamental uncertainty of markets, ignored Bitcoin's crazy volatility because he felt he knew better. Markets demand humility. Past success is no guarantee. It can even set you up for a bigger fall by making you think you've cracked it.
Okay, overconfidence. What's another big one? Something tied more to just how we feel about gains and losses.
Ah, yes. Loss aversion and its partner, the disposition effect. This is huge.
Explain it.
Well, research shows pretty conclusively that the pain of losing, say, $100 hurts us psychologically way more than the pleasure of gaining $100 feels good. We're wired to avoid losses.
Okay, so we hate losing more than we like winning. How does that play out?
It leads directly to this disposition effect. It's this documented tendency we have to sell our winning investments too early.
To lock in the gain. Avoid the pain of seeing it shrink.
Exactly. And conversely, we hold on to our losing investments for far too long.
Because selling means admitting we were wrong, and that hurts, realizing the loss.
Precisely. We avoid that pain. Which brings us to that story of the friend who traded futures. That's such a powerful, almost textbook example of this.
Yeah, tell us about that again. He was doing really well initially.
Incredibly well. During a bull run, he was using unrealized profits paper gains to keep adding to his winning positions. Turned $500 into tens of millions, riding the wave.
Amazing. But then
Then came a downturn. And based on his fundamental analysis, he strongly believed the market should recover. So he started adding to a losing position, using those floating losses.
doubling down on a loser because he couldn't accept being wrong.
It seems like it. His overconfidence in his analysis, combined with that intense pain of loss aversion, he just couldn't take a small loss early. He kept sort of gambling, adding more, hoping for that all-or-nothing reversal.
Until
Boom, margin call, lost almost everything, ended up with less than $1 million from tens of millions.
Wow.
Both he and James Wayne made money incredibly fast, and that speed, it just dangerously inflates confidence, warps how you see risk. It really highlights that saying, holding on to wealth can be much, much harder than making it in the first place.
Okay, so we've seen the crash driven by psychology, the complex market mechanics with surprising retail strength, and these deep mental traps. Let's pivot now. What's the antidote? How do we master risk? What can we actually learn from the top pros, the really successful fund managers?
Right. The sources really emphasize this. The absolute core skill of the best fund managers, the PMs, isn't just picking the next Amazon. It's, first and foremost, extreme risk management.
And that becomes even more vital when things get choppy, right? Like when the VIX, that volatility index, spikes up towards 50 or higher.
Exactly. When volatility goes nuts like that, just picking good stocks gets way harder because everything starts moving together. Correlation spikes. It's all about systemic risk then, not just individual company stuff.
So the main goal shifts.
Completely. It shifts to preserving capital, protecting what you have.
Yeah.
This is super critical for investors later in life, obviously. But as James Wayne proved, failing to protect your principal can kill you at any stage.
So how do these top PMs hedge effectively? It can't just be shorting random stocks they don't like.
No. It's much more sophisticated. It's about matching risk profiles. Your defensive shorts, the bets against the market, they need to match the risk characteristics of your long positions, the things you own. Meaning you can't own a portfolio full of high-flying, high-beta tech stocks and expect to hedge it effectively by shorting, say, stable utility companies. It just doesn't work well.
So you need to short similar types of risky assets.
To truly hedge against that broad market, systemic risk affecting your longs.
Yeah.
You need to actively short assets or sectors that share a similar high volatility profile, sometimes even things that might be considered junk stocks. The source mentions how Tesla, for instance, used to be viewed in that context by some for hedging purposes.
Got it. And they also talk about just pulling back overall, reducing exposure.
Absolutely. Think of it like a ship captain, right? Storms brewing, you reduce the amount of sail you have up. Experienced investors, top PMs, they significantly lower their overall market exposure, their gross exposure.
Less leverage, selling things.
Both. Reducing leverage, selling positions, raising cash. Especially when volatility is rising and market liquidity, the ease of buying and selling starts drying up. Because you could be right on your trades many times, make good money.
But one big mistake can wipe you out.
One single, unmanaged liquidation event like Wayne's can erase everything. Your principal, your gains, your ability to even play anymore. We see this principle in action from legends, right? Buffett selling when things were frothy to have cash for the downturn. Michael Burry clearing out positions like those Chinese concept stocks when he saw risks escalating.
Okay, this has been a really comprehensive deep dive. We went from that crazy personal story of James Wayne to the surprising mechanics of the rally, the psychological traps inside our own heads, and now the core principles of institutional risk management. How do we tie this all together for, the listener? What does it mean for your personal investing?
Right, let's bring it home. Starting with U.S. stocks. The sources are pretty blunt here. For most individuals, consistently beating the market is incredibly difficult.
Like, basically impossible.
Well, the numbers suggest something like 95% to 96% of active fund managers fail to beat their benchmark index over the long haul. So, the odds are heavily stacked against active stock picking for most people.
So what's the best core strategy then for the average person?
Dollar cost averaging, or DCA, regularly investing a fixed amount into broad passive ETFs that just track the market. Think SPY for the S&P 500 or QQQ for the NASDAQ 100.
Takes timing out of it, reduces single stock risk.
Exactly. And the source also suggests maybe considering diversifying with some safe haven assets like gold, maybe via an ETF like GLD. But the main message is, unless you genuinely have a proven edge, probably avoid trying to pick individual stocks.
Okay. Now, what about the current market? We talked about high valuations, that Schiller PE near 36 versus an average of 17.
Yeah, historically high.
SPY and QQQ are near their old highs, but momentum seems a bit weak lately, kind of drifting down since mid-May. The market doesn't feel like it's screaming higher right now.
Agreed. It doesn't show strong upward conviction at the moment.
So in this environment, what kind of strategy makes sense, keeping risk in mind?
Well, if you're not expecting huge capital gains immediately and valuations look stretched, you could consider strategies that basically express that view. I don't expect massive gains soon. One way is covered calls.
Where you own the stock and sell call options against it.
Right. It generates income, kind of like creating your own dividend payments. Or you could look at ETFs designed to do similar things, like JPY or GPQ mentioned in the sources. They aim to provide income if the market stays flat or only grinds slightly higher.
Okay, income focus rather than big price jumps. But there's a catch with those ETFs, JPY and JPQ, isn't there? If you just buy the ETF itself.
Absolutely critical point. If you buy JPY or JPQ without owning the underlying stocks they track, you are still fully exposed to downside risk. If the market tanks, the value of those ETFs will fall significantly, even with the dividends they pay out.
So they aren't a magic bullet for avoiding losses?
Definitely not. The goal there is income generation in a sideways or slightly up market, acknowledging you still have that principal risk if things go south hard. Right. It's not about capturing big stock price gains.
Gotcha. Okay. Shifting gears to crypto. Especially after James Wayne's blow up and the recent dip, is this the time to jump in and buy the dip?
The source advises strongly against aggressive dip buying in crypto right now. It sounds counterintuitive, but for really high volatility assets like Bitcoin.
Yeah.
Sometimes chasing rising prices, riding proven momentum, can actually be less risky than trying to catch a falling knife during a sharp correction.
Really? Why is that?
Because corrections can go much further than you think. Wayne's liquidation itself added negative sentiment, washed out leverage. And without those quick, easy profits we saw earlier, retail participation tends to dry up, reducing the buying power needed to push prices back up quickly.
So the best move now, according to the analysis?
Probably just stay out of this volatile consolidation range. Wait until a clearer trend up or down actually emerges. Don't try to guess the bottom.
Okay, so wrapping all this up. We've covered James Wayne's wild ride, the surprising market drivers, the psychological traps. What's the final synthesis? The survival guide takeaway?
I think in this world, just overloaded with information, noise, constant emotional swings.
Right.
The key is independent critical thinking based on solid principles. Markets aren't these fairy tales of easy riches.
Right.
Achieving long-term stable returns, and maybe more importantly, keeping them, boils down to a few core things. First, you need to develop an edge.
A strategy that actually works over time, not just luck.
Exactly. A strategy with a positive expected value based on real analysis. Second, you need disciplined execution of that strategy over the long haul. Actively fighting those behavioral biases we talked about, the overconfidence, the loss aversion.
Easier said than done.
Much easier said than done. And finally, maybe the most crucial part, finding a trading system, an investment approach that genuinely fits you, your personal risk tolerance, your personality. Not everyone can handle or should even try the kind of extreme leverage James Wayne used. And that's perfectly okay.
So survival isn't just finding winners. It's about not getting taken out by the risks. or by your own head.
That's a great way to put it. Don't let the risks or your own psychology knock you out of the game.
So looking back, we started with that incredible $1.25 billion liquidation story. We peeled back the layers on the U.S. stock rally, saw the power of retail and passive flows. We dove into those psychological traps, overconfidence, loss aversion, using some powerful examples. And then we explored how the pros manage risk, capital preservation, smart hedging, cutting exposure.
Yeah, and the whole point of this deep dive wasn't just to tell stories or crunch numbers. It was really aimed at arming you, the listener, with the knowledge, the perspective you need to navigate these really complex financial waters to help you make smarter decisions, not just about what to buy or sell, but how to manage yourself through it all.
And crucially, how to protect your capital, not just from market swings, but from your own potential human errors.
Exactly.
So here's a final provocative thought to chew on after all this. How much of real investing success isn't actually about predicting the market perfectly, but really about managing yourself, about understanding that sometimes your own mind is your biggest opponent? How are you going to take these lessons on risk, on behavior, and actually integrate them into your own strategy moving forward?
And just to mention, the sources did note there's a tool currently in development undergoing internal testing this week, apparently, which aims to potentially help investors steer clear of some of these common pitfalls.
Interesting.
And for more content, deeper dives into some of the trading strategies and analyses we touched on from the sources, you can also subscribe to the electronic newsletter that was discussed.
Okay. That's all for this deep dive. We really hope this is giving you some valuable insights, maybe a fresh perspective on the markets, and maybe even on yourself as an investor.